أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. We're going to discuss chapter 4 today, which is accrual accounting concepts. Included in our discussion today are 4 topics. The first one is the timing issues of recording the transactions. The second is the basics of adjusting entries, what adjusting entries are and what you record. The third is preparing the adjusted trial balance and financial statements. And the last is closing the books. For the purposes of accounting, accountants divide the economic life of businesses into artificial time periods, and they report the results of the operations for those artificial time periods. For example, a month or a quarter or a year, etc. There is something called the revenue recognition principle, which dictates that the revenue is considered as earned in the period when the obligations are satisfied. So if a service company provides a service during the month of January, then the revenue will be recognized in the month of January, even if the payment was received before or after January. Consider this example of Conrad Dry Cleaners. They clean the clothes in January, but the customers don't take the clothes until July. So the revenue would be recognized in June when the services are completed, and you would record debit to accounts receivable and credit to service revenue in June. And then in July, when the cash is received, you would debit cash and you would credit the accounts receivable. The expense recognition principle dictates that the expenses should be matched with the revenue that those expenses generated. So expenses related to the service provided to the customer should be recorded in the same period when the service is provided. If we put these together, the revenue recognition principle and the expense recognition principle, we have the periodicity assumption, which means the revenues should be recognized in the period when the services or goods are provided, and the expenses should be recognized in the period when we record the revenues related to those expenses. So these two put together, we have the revenue and expense recognition principle, which is mandated by the generally accepted accounting principles. There are two bases of accounting. One is the accrual basis and the other one is cash basis. In accrual basis accounting, revenues are recognized when services are performed, and the expenses are recognized when they're incurred in the same period when the revenues are earned that are related to those expenses, which we just discussed. However, the cash basis accounting is different, because in cash basis accounting, revenues are only recognized when cash is received, regardless of when the service is performed. And the expenses are recognized only when the cash is paid, regardless of when the expenses are incurred. Cash basis accounting is not allowed under the generally accepted accounting principles. Here we have a contrast between the accrual basis and the cash basis accounting. As you see here, in 2013, both revenues and expenses are recognized under the accrual basis because the revenue was earned in 2013 and the expenses were incurred in 2013, which are matched with the revenue, showing a net income of $30,000, and that makes perfect sense. On the contrary, in the cash basis accounting, you see the expenses were incurred in 2013, so they are reported in 2013, showing a loss of $50,000, and the revenues were received in 2014, and they reported in 2014 showing a net income of $80,000. So you can see why the cash basis accounting is not allowed under generally accepted accounting principles, because it does not show the true picture of the business operations. In the accrual basis accounting, we have the concept of adjusting entries, which make sure that the revenue is recognized and the expense is recognized when the revenue is earned and when the expenses are incurred. And this is required every time when a company prepares a set of financial statements. Usually, the adjusting entries include one income statement account and one balance sheet account. And we're going to look at this concept in more details. As you see here, we have two different types of adjusting entries. The first type is called deferrals. Under the deferrals, the first one is prepaid expenses. This happens when a company pays in advance for some service or some good that it's going to receive in the future. And this is considered as an asset. So you debit the asset, which is the prepaid expense, and you credit the cash, which is paid in advance. The second one under deferrals is unearned revenues. This is where a company receives cash from one of its customers, and in exchange for this cash, the company is going to perform some service or provide some good in the future. This is considered a liability. So the cash is debited and unearned is credited as a liability. The accruals is the second type. The first one under the accruals is accrued revenues, and this is revenues for services performed but the payment not received. So if the company performs the services and then receives the payment in the future, then accrued revenue is recorded. This is usually recorded in the form of accounts receivable. The second one under accruals is accrued expenses, where expenses are incurred but not paid. So the company perhaps receives some services such as cleaning or gardening or something, and it has not paid for those services. So this would be recorded as accrued expenses. This is normally recorded as accounts payable. Here are some examples of prepaid expenses where the company pays for a service or a particular good in advance, such as insurance, supplies, advertising, rent, purchase of an equipment, purchase of a building or purchase towards a building, etc. So the money is paid in advance before the item is received or before the service is received. The prepaid expenses, as I mentioned, are reported as an asset, and the asset expires with the passage of time for items such as insurance, advertising, or through usage such as supplies. And an adjusting entry is made to increase or debit the expense account and to decrease the asset account, which is credited. In the case of a long-lived asset such as a building or an equipment which is purchased or built and paid for, and then it's used over a long period of time, we use the concept of depreciation, which is reducing the book value of the asset over the life of the asset. This does not necessarily equal to the fair market value of the asset. So for example, if we have an asset that is $5,000 worth and we purchase it and we use it for 5 years, every year we're going to record depreciation for 1/5, which is 1,000 of the $5,000 equipment, and then we are going to report on the balance sheet a reduced net book value every year, and we will recognize as expense that same amount every year until we reach the salvage value of the equipment. And the depreciation concept is discussed further in another chapter. As for the unearned revenues, these are payments received in advance from customers for which service must be provided in the future, or some goods must be provided in the future, such as rent, airline tickets. The airline company receives the payment in advance, so it's a liability on the airline to take those passengers to their destinations on the promised date. So when the airline does that, this unearned revenue becomes earned. Prepaid magazine subscriptions, for example, is another one. Or if the customer makes a deposit for a good or a service, that also becomes an unearned revenue until the services or the goods are delivered. Similar to the prepaid expenses, adjusting entries must be made for unearned revenues when the revenue is earned. So an adjusting entry results in a decrease or a debit to the liability account, which is the unearned revenue, and an increase or a credit to the revenue account. So the purpose of both the adjusting entries for the prepaids and the adjusting entries for the unearned revenues is to recognize the expenses and the revenues when they are actually earned and incurred. And if the daily entries do not capture those adjustments, then at the end of the period, the adjusting entries must be made. When it comes to accrued revenues, this includes services performed before receiving the payment. And usually an accounts receivable is recorded from the customer, and they could include any service or sometimes even rent. If the customer pays rent at the end, for example, in a hotel, the customer first stays and then they pay the rent. So the accrued revenue applies in this type of situations. The accrued revenues serve two purposes. The first one is to record the receivable from the customer, and it shows on the balance sheet under the current assets. And then the second purpose is to record the revenues that have been earned before the payment is received. When it comes to accrued expenses, these are expenses that have been incurred or services that have been used before making the payment. So usually an accounts payable is recorded for the suppliers in the liability side of the balance sheet, and they're usually recorded as current liabilities because they're paid very quickly. And these could include, again, rent or security services, taxes, for example, or salaries to employees. So these are services used or expenses incurred before payments are made. The purpose of the adjusting entries for accrued expenses are also twofold. The first one is to recognize the obligation or the payable on the balance sheet, and then recognize the expenses on the income statement. Here we have the summary of the basic relationships among the different accounts for the accrued expenses. And the first one, as you see, is prepaid expenses. Before the adjustment, the assets are overstated and the expenses are understated, and the adjusting entry adjusts both of those accounts by debiting expenses and by crediting assets. For the unearned revenues, before the adjustment, the liabilities are overstated and the revenues are understated. And when the unearned revenue is earned, the liability is debited, which is the unearned revenue, and the revenues are credited. When it comes to accrued revenues, the assets are understated and the revenues are understated before the adjusting entry, and the adjusting entry debits the asset and credits the revenue, and it adjusts the accounts. The last one, accrued expenses. The expenses are understated and the liabilities are also understated before the entry is made, and the adjusting entry debits the expenses and it credits the liabilities, and it adjusts both the accounts. In the accounting information system, the next stage is to prepare an adjusted trial balance. So once the adjusting entries have been made, the journal entries have been recorded, the trial balance that was initially prepared is adjusted. Now in class we go through the preparation of the journal entries, the T accounts, the trial balance, and then the recording of the adjusting entries, and then the preparation of adjusted trial balance. And the lectures coupled with those exercises will bring all of this together for you. The purpose of recording the adjusting entries and preparing the adjusted trial balance and then a financial statement from the adjusted trial balance is to ensure the quality of the earnings, to ensure that each item is recorded in the proper period when it comes to revenues and expenses. And these adjusting entries should not be used to unethically smooth out the income or the expenses and to inflate the revenues in the short run, or making improper adjusting entries to reduce the expenses. The purpose of the adjusting entries is to ensure that everything is reported in the proper period and the right amount of income and expenses and the right balance of assets and liabilities are recorded in each period. Once the adjusting entries are made and the adjusted trial balance is prepared, a final set of financial statements are prepared based on the adjusted trial balance, as we are going to prepare in class. Then the books are closed, and there are some accounts that are temporary and there are some accounts that are permanent. The permanent accounts carry over to the following accounting period, but the temporary accounts, which include revenues, expenses, and dividends, are zeroed out, are closed into the retained earnings in a two-step process, as we are going to see next. So here is the process of closing the books. All the revenue accounts are debited and an account called income summary is credited in one journal entry. And in another journal entry, all the expense accounts are credited and the income summary account is debited. Then the balance of the income summary account is closed into the retained earnings by debiting the income summary account and crediting the retained earnings account. The dividends account is directly closed into the retained earnings by debiting the retained earnings account and by crediting the dividends. As I mentioned, the purpose of these closing entries is to ensure that all temporary accounts are made zero and closed out, so that the following accounting period starts with a zero balance in items such as the revenues and the expenses as well as the dividends. As far as the assets and the liabilities and equities are concerned, all of those accounts carry forward and start with their balance from the end of the previous period. So here we have all of those 9 steps in the accounting cycle completed, starting from analyzing the business transactions all the way to the preparation of the post-closing trial balance. Now we are going to do one in-class exercise that covers all of these 9 steps, and then you're going to do a few homework exercises that go through the 9 steps in the accounting cycle. This is a little bit involved, and to feel a little overwhelmed at the beginning is normal, but as we go through the 9 steps a few times, they will become easier and easier, inshallah. So with that, we finish today's lecture. Assalamu alaikum wa rahmatullahi wa barakatuh.